Namaskar, welcome to Whitel. Here we will explore how did BYJU, an edutech platform once valued at more than $20 billion, end up facing lawsuits, debt problems, investor exit, and a collapse in valuation.
The tale of BYJU'S begins with a passionate educator who inspired countless students by demystifying complex concepts. This teacher cleverly utilized his knack for simplifying challenging subjects, turning the study of competitive exams into a captivating journey for learners. Students flocked to him, eager to absorb knowledge and gain an edge. As technology surged and smartphones became ubiquitous, BYJU'S transitioned from traditional classroom coaching to a dynamic digital education platform. Embracing this change, they thrived in an environment ripe for innovation. The prospect of reaching millions of students and tapping into the significant budget that parents allocated for education drew eager investors into the fold. The company blossomed, transforming its ambitious vision into substantial growth as India embraced the digital age. When the whirlwind of the COVID-19 pandemic swept schools into uncertainty, BYJU'S found itself in a prime position. With students confined to their homes, online education became the lifeline in a world turned upside down. BYJU'S reaped the rewards as parents sought quality learning solutions amidst rising fears and uncertainty. Investment flowed like water, and the company achieved a remarkable peak valuation of about $22 billion, epitomizing the fusion of technology and education. Yet behind the gleaming facade of success, systematic issues began to emerge. The company's strategy of aggressive growth overshadowed older, proven models of profitability. A major mistake became apparent: the pursuit of expansion at all costs. The vision was grand, attempting to acquire competitors, penetrate new markets, and introduce an ever-expanding array of products. However, as BYJU'S sped forward, it failed to recognize that rapid growth often obscures underlying operational frailties. The insatiable quest for acquisition also became detrimental. Billions were funneled into purchasing various educational businesses, from coding platforms to international firms. While the goal was world domination in the education sector, the complexities of merging distinct cultures, technologies, and management styles proved challenging. Integration, a vital step for successful mergers, quickly illustrated how buying companies doesn't guarantee smooth sailing. Moreover, BYJU'S grew increasingly reliant on investor funds to maintain its rapid expansion. This dependence on external financing might work initially, but as investors' confidence wavered in turbulent markets, it turned into a precarious situation. For years, backers stood firmly behind the brand, but the financial landscape is a fickle friend. When investor confidence waned, the company faced a daunting challenge to sustain its growth through self-sufficient cash generation. In the world of business, the precarious balance between growth and sustainability often defines the trajectory of a company. The recent struggles of BYJU'S, a prominent player in online education, serve as a stark reminder of this complexity. While the early 2020s heralded a boom in demand spurred by the pandemic, not all that glitters is gold, as evidenced by their significant missteps, particularly related to debt accumulation and governance. The first critical mistake was assuming that extraordinary demand would be a permanent state. As institutions opened their doors once more, many students shifted back to in-person learning, leading to a normalization of demand. Companies built on the assumption of continued exponential growth found themselves unprepared for the sudden transition back to reality. The second pivotal error was the reliance on debt as a means of growth. In an environment of low interest rates, BYJU'S raised an astronomical loan of $1.2 billion, seemingly a clever financial move. However, the obligations that accompany such capital became a heavy burden when the winds of fortune reversed. Growth slowed and cash flow tightened, revealing the latent risks associated with leveraged investments. What appeared to be an astute use of financial leverage during prosperous times rapidly transformed into a perilous trap. Moreover, governance and transparency issues surfaced, further undermining investor confidence. When the integrity of financial statements is questioned, trust begins to erode. Delays in reporting, auditor resignations, and board-level disputes painted a concerning picture for stakeholders. As mistrust festered, the company's growth faltered, and the pressure from debt became more pronounced. This chain reaction eventually illustrated the domino effect in corporate governance. Diminished confidence led to investor wariness, which in turn caused valuations to plummet and legal disputes to arise. The ensuing financial spiral was fueled by one misstep, intensifying the next, creating an atmosphere of uncertainty that proved nearly impossible to escape. For entrepreneurs seeking wisdom from BYJU'S experience, the lessons are clear. Sustainable growth cannot be equated with success. Operational excellence supersedes mere acquisitions. Investor funding shouldn't replace profitability. Additionally, the risks of debt amplify both triumphs and failures, while transparent governance emerges as crucial for long-term viability. The cyclical nature of markets reminds companies that favorable conditions can evaporate swiftly, emphasizing the necessity for preparation in both prosperous and challenging times. The tale of BYJU'S underscores the importance of vigilance and adaptability in navigating the business landscape.